In Asia, most investors have decided at this point it's not worth it. They've had bad experiences, currencies have gone against them. They've said, you know what, I'm going to come back to the US, it feels a lot safer to me. And they've said, look, these places I thought they were going to grow 7 to 10% a year, they're actually growing at 4 to 6%. I would just point out that 4 to 6% is a lot higher than what you're seeing in the US, in Europe, in Japan. Urbanization, improved infrastructure, increasing consumption, all those things continue in the emerging markets. And just to give you some context on this, in London and New York, which global investors would tell you are their two favorite cities to invest, office absorption in the last couple of years has averaged 1% of stock. In Shanghai and Mumbai, it's been 6 to 8%. These places have real underlying demand. And today, a lot less capital seems to be interested and focused in these markets. So supply, as I touched on, is down, and also asset pricing is down. And that's generally a better time to go in than when everyone decides this is the place to be. We bought control of a large Chinese mall company at the end of last year that in a different environment would have had the ability to go public. Today, most Chinese public companies are trading at big discounts to NAV, so private capital can make an investment. In India, we've been buying very high quality office parks at 11, 12% cap rates in a market most people have decided is really too unsafe to invest in. And as investors, of course, to generate high returns, oftentimes you have to look at the world a little bit differently. I would say, for those of you who look at emerging markets, don't lose faith. We think the most interesting way to play those markets is the rise of consumption around logistics and retail. People want to consume things, you've got to move those goods. We think those are interesting ways to play those themes. A few